Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Today we are diving into software stocks that I believe are undervalued right now. These are high quality businesses with strong fundamentals, long-term growth, and importantly they are all Sharia compliant, so we have nothing to worry about. Now just remember, I'm not a financial advisor, so when you are doing your research and so on, please just don't rely on me. Make sure you are doing your own research as well, inshallah. So why am I looking at software companies right now? So we are in a market where tech has been leading for quite some time, and the majority of the tech companies, especially semis, have done an absolutely amazing job. But in fact, there are several top tier companies that have pulled back quite a bit, and for the short term phase, people are worried about, I don't know, these companies not investing in AI or whatever it is, even though their long term growth basically story has not actually changed. So these companies are still generating profit, still have actually product people are buying and so on. And top of that, they have what's called a recurring revenue. And that recurring revenue is the most important thing about these companies. They have a very high margins and scalable products. Remember, they create the software once, they sell it to you, and then all they do is they sell it to the next person without making any changes, because it is exactly the same software that they've created once, and basically they're not actually recreating that once they've sold that product. And this is one of the things I love about that recurring revenue. Once basically Adobe, for example, creates a software, it's online, you just buy the software, you download it and you pay for it, and then that's it. The next person does the same thing and the same thing. So you're creating it once and you're multiplying as many times as you possibly can, and that's the reason why these companies have a very high margins. And now what we're going to do is look at the companies, each one of them. I'll give you a little bit of information about each one of them. Like I said, please do your own research before you invest in any of these companies. And the usual things that we're looking for is the 5-year growth revenue for the last 5 years, the compound annual growth rate. We look for EPS, we're looking for the profit margins, the return on equity and return on invested capital, which kind of helps us to see if the companies is profitable and the management is actually doing a good job using the capital that's available to them by reinvesting in the business and growing the business even further. Then we look at things like the free cash flow. Free cash flow is important because that's the money the company uses to buy back their own shares, to issue dividends if that's what they're doing, and they can also pay off any debt the company has to reinvest it in the business. There's a lot they can do with the free cash flow, which is important to us to see actually how much do they have right now. Especially in 2020 when interest rates were going up, a lot of these companies went down so much because some of them don't have a free cash flow, which means they need to go to the bank and just basically get a loan. Now that loan is going to cost a lot more money because the interest rate has gone up a lot. So that's why a lot of the high flying stocks went down so much in the tech world, if you like. Then we look at the EPS growth for next year. So what is the expectation? Remember, that's just expectation. That can easily change. And also we look at revenue, and then we look at the Morningstar valuation. And then finally we will be looking at the fast graph to see whether they think it's actually overvalued, undervalued, and so on. And the first company we're looking at today is Salesforce. Salesforce is the global leader in customer relationship management. Companies rely on this platform to manage sales, marketing, and customer data. Their revenue is basically still growing strongly. As you can see here, basically we've got about 9% growth expected next year, 12% when it comes to EPS. They have a very high free cash flow margin. As you can see here, they've got absolutely amazing $12.6 billion of free cash flow. In terms of profitability, they get in there. So as you can see here, we've got 16% profit margin, which is really good. Return on equity, return on invested capital. The other things that you can also basically do is just to do a little bit more research. I'm only going to do for this one. The rest of them you can actually look at it. If you go to websites like Seeking Alpha and click revenue or click basically the income statement, this is the revenue that they've made over the last whatever years. So this is the latest one. That's the trailing 12 months. So $38.5 billion is how much they've made. The cost of that, to make that, basically they only spent about, let's call it $9 billion, right? Look at that gross profit, closer to 30 billion of the $38 billion they've made was a gross profit. But of course they use a lot of that money for sales in general, basically admin expenses and things like that, especially Salesforce. They've got celebrities promoting the company, whatever, so they're spending a lot more money, which in the long run I think that's going to stop once the company matures a little bit more. but they spend a lot of money in those kind of things. And then at the end, we've got the net income, which is about $6.2 billion. Now, looking at the Morningstar valuation, is almost a 40%, basically has a 40% upside from where we are right now. $325 per share is where they think the price should be, which is very interesting. Look, right now it's only $233 per share. If we look at fast graph and we're using the estimates, for example, which is that 15 PE, of course, this company is not going to trade 15 PE. It has never done that before, so it's a little bit stupid to actually even use this. So if we use the normal multiple, and it's just give yourself a little bit margin of safety, if you like, right now that basically that 40 PE is maybe a bit too much. So if you even using like the 24, between 24 and 30 PE, and that's what you aiming for, then you can still make about $5,000. If you invest 10,000 right now, you'll be still making 5,000 top of that by the time we get to 2028. The next one we're looking at is a company that is very similar to Salesforce, but slightly different in terms of their business wise. So ServiceNow focuses on workflow automation for enterprises. Think of like the operating system for large organizations to run efficiently. That's basically it. And they're consistently growing their revenue at 20% plus annually every single year. They're expanding into the AI basically driven automation, if you like. They're basically the recent dip in shares price is more micro driven than actually the actual business being worrying about the actual business itself. And as you can see here, we've got about 20% upside, 19% upside from where we are. So $1,000 is basically where they think the price should be. Right now is $850 per share. They grow basically that revenue compound annual growth rate of 25% in the last 5 years. EPS we're expecting it was not expected. They grew that basically in EPS for the last 5 years about 56%, which is absolutely huge. And they have excellent free cash flow of over $3 billion, which is nice to see. They are expected to grow massively next couple of basically next year, just only next year. And if we go on fast graph and have a look at this business as well, let's go back here, and if we check out the forecaster for this business, again, using the normal multiple of like 15 or 19, whatever, it doesn't really make a lot of sense. But if you use the normal multiple for this company, and that 84 might be actually a bit too much. So you can still say basically the company might even be in the 50s, and you can still make a list of 4,000 top of that, top of the 10,000 you've actually initially invested. So when you look at the fast graph, it seems I would still add 10% basically margin of safety just to be on the safe side. But yeah, it is another company that seems undervalued at this point in time. And yeah, the next one is Adobe. Adobe doesn't need introduction. If you say Photoshop, everyone knows. Now the issue is this company, because of Figma and other companies that are in the same industry, people think this company is dead and no one is actually looking at it. I promise you, the company still has a very predictable subscription model. So they have that subscription model, which is actually very predictable income. People have subscribed to do this business for 2, 3, 4 years basically in advance, and they have, as soon as that subscription is over, they renew automatically without even thinking about it. Now there might be other companies for like content creators and so on, but when you think about the big companies that have been using this software for a very long time, it's very difficult for them to kind of completely switch. And the fact is they are also getting into AI. They've got the Firefly and everything else. So right now people are saying, yeah, the company is dead, is not actually going to do anything. But I promise you, it's one of those situations where people are fearful and running away from this company. But I think it's a sleeping giant, and sooner or later it's going to wake up, and we're going to realize we're actually missing out a lot, because they do have excellent free cash flow of about $10 billion that they can still invest into the business to grow it if they need to. They still have that subscription model where they creating the software once, and again, gain a massive profits from it. Look at the profit margins. And if we go on sales, if we go here, let's have a look at the similar thing again. The income statement from $20 billion is basically $22 billion is what they made basically in trailing 12 months. They only spent 2.4 of that. 20 billion was actually gross profit. That's where that basically 30-something% comes from, which is very important to actually understand those things. Some people are just basically running away from these companies just because they don't understand the business model. Look at the net income of $6.8 billion. That's going to go into become a free cash flow soon. So it is very important to understand what you're buying, why you're buying, what the trend is right now. But at the same time, you just need to know these companies. Yes, don't take my word for it. Don't buy the company because I said so. But in my opinion, this company is not dead. 61% upside from where we are. $560 per share is where they think the price should be. If we go on here and have a look at what Fastgraph thinks about this company, and we're just looking at the normal. If you bought this stock right now, you'd be making 10% and on top of your money. So that will be just about $1,000 by the end of 2027, by November 2027. But if we use the normal multiple where it's been over the last whatever years, again, you can make at least 107, almost 180% on top of your money. So your 10,000 will become 20, almost to 28,000. Now, I don't think that's realistic, knowing the company, and the fact is they are growing. Yeah, they are basically growing, but it's not massive. Okay, so for that reason, I probably would say maybe say 26 PE, for example, right? You can still make about 10,000 on top of your money, which is absolutely amazing. Double your money within basically 2+ years. So it is important to know what you're buying and why you're buying and where the company is. The next one that we're going to look at today is Autodesk. This is where the design is used. Anyone who's architect, anyone who's building constructions or whatever, this is the company basically they go to. So it's a leader in the design and engineering software like AutoCAD and Revit, for example. It has huge presence in constructions, architect, manufacturing, and so on. They have a recurring subscription model, which provides a stability for the company. Again, very similar to Adobe, very similar to Salesforce and ServiceNow. Again, that recurring revenue is important, and right now is down a lot because the market is worried about construction is slowing down, but long-term demand for digital design is still growing. And as you can see right now, it's about 4% upside from where we are. They have excellent free cash flow. They're very profitable businesses. They have been doing well over the last whatever years. And what we're going to do now is look at sales, look at the fast graph. And as you can see here, it seems very much overvalued if you are looking at the estimate, which is that 15 PE. If you look at the normal multiple, which basically over the last 5 years, the reason I used basically look at normal multiples is because where it's been over the last 5 years. So you want to kind of compare that with it. So the last 5 years, we're looking about almost a 47, which is basically there. So if you bought this stock right now and that was the truth, so PE from moving forward, okay, the forward PE if you like, that you will be making about another $11,000 on top of your money basically. But if you are saying, okay, maybe that's not going to happen, maybe it might slow down, let me look at about 32 PE, whatever. In fact, let's just go here and I want to see if this company ADSK, what the current forward PE is for this stock. It's about 30. Okay, so if we even use that 29.30, you'll still be making about $3,000, closer to $3,000 by the time we get to 2028, which is quite decent. The next one is a very interesting one, one that has been on my radar for quite some time, and that's Fair Isaac Corporation. This is very well known for credit scoring models. They have loads of different credit scoring models, but it's also a software provider for analytics and decision making in financial services. Is basically highly specialized in niche within limited basically competition. So it's very interesting. It has its own sort of a market, niche market if you like. So the stock had a big run but recently cooled off, given a better entry point up in my opinion for long-term investors. And as you can see here, we've got about 22% upside from where we are. $1,600 per share is where they think the price should be. Right now we're looking about $1,300 if you like. And now one thing I don't like about this company is the free cash flow. The company that has a market cap of 31 billion should be having at least a slightly higher free cash flow in my opinion. So I don't understand why that is basically. And if we go in here and have a look at some of the things, especially the financials, I want to see. So they're making about 2 billion, spending about 350 something, 1.5 becomes gross profit, and then they're spending quite a bit in them in terms of research and development and things like that. And the net income, which is what I'm after, is quite low. It is growing, but it's quite low, the net income. So It'd be interesting to see how the company does overall. But right now, it seems basically very much undervalued at this point in time. If we look at fast graph, for example, it seems very much expensive right now. You will be losing about 24% if we are using that 22 PE. If we use the normal multiple, where it has been over the last whatever years, you could make about 31% basically in total, or 13,124. That's what you will have by the end of 2027. Now, if we say maybe that's not the case and shouldn't be trading that sort of price or PE, maybe basically about 27 or so on, then you'll be losing a little bit of money. This is the only one I'll be saying, honestly, I would want to wait a little bit longer to see where it ends up, because it has been coming down quite a bit. Although it's based on Morningstar saying 22% upside from where we are, I would love to have a little bit of margin of safety based on basically the growth expectations. A company that has a yield, EPS yield of basically 2%. It's not huge, but they're expected to grow up the adjusted operating earnings growth rate of 27, almost to 23%, which is quite nice. Okay, don't get me wrong. In fact, if we go back here, you will see, if you click earnings, for example, you could see about 24% this year, 20% to another 24%, revenue about 15% every single year for the next few years. So that's still a very interesting company, but I think I would love to have a slightly lower, maybe if it comes down to, I don't know, 1200. I'm going to have to do a little bit more research before and then add it to my watch list. But yeah, I've done enough research, but all I'm saying is I'm going to do a bit more digging in terms of valuation side of things. But just from the outset right now, it seems it's a great price, but I would love to have a little bit cheaper than that. Accenture is the next one, 149 billion market cap. This is, it's not just consultant basically company. It's a huge portion of their business comes from digital transformation and software implementation. So AI came out, a lot of companies went to this company and said, okay, how do I implement AI into my business? This is the company they go to, and then Accenture comes in and does this magic by implementing IT into their business, if you like. And as you can see here, 7% upside from where we are, and I think it's down a lot. Let me have a look again. Yeah, a year to date of basically 30% down. That's absolutely huge. But again, it's now heading towards the 52-week highs rather than the 52-week lows, which is very interesting. But it's still about 7% basically upside from where we are according to Morningstar valuation. Now, looking at fast graph, as you can see, we are maybe about 3%. You will lose about 3% if we are using that 15 PE. But if we use the normal multiple where it has been trading over the last basically 5 years, which is that about 28, 29 PE, you'll be actually making about 33% annualized rate of return, which is absolutely huge. So 18,000 is what you will have by the time we get to 2027. And the final one that we're going to talk about today is Palo Alto Networks, a cybersecurity company, a company that is one of the leading companies in my opinion. Security software spending is one of the basically the last thing basically companies will cut. No matter what happens, where we hit a recession or no recession, these companies will never cut when it comes to basically their cybersecurity protections, that side of things, because of everything that has happened. It has a strong growth in recurring revenue from subscription services. This expanding product range to become a fully cybersecurity platform. The stock has basically dipped recently, offering a potential attractive basically long-term investors, basically in my opinion. So it is a very interesting company overall, and it is the right place to be honest right now, because everyone is spending money on AI and cybersecurity, just to make sure that whatever the products that they have is protected and so on. 21% upside from where we are, which is very interesting. Very profitable company. They've got about over $3 billion of free cash flow. They expect it to grow nicely over the next 5 years, next year in fact, and I think the next couple of years. Let's have a look again. If we look at W, what basically they expect. If we go to earnings expectations moving forward, 15%, 12%, 14%, again another 12% in terms of EPS. Revenue more or less the same. So they are expecting the company to grow nicely. And if we check it out here, let's see, probably will say it's very expensive. There we go, really expensive. You will be losing about 61% if we are using that 15 PE. But Palo Alto Networks is not basically, you will never see that company trading 15 PE anyway. 15 multiples is not the what you should be using. But if you look at that 57, which is basically where it has been over the last 5 years, you'll be making basically 47%, almost a 48% on top of basically total annualized rate of return, which is absolutely amazing. So yeah, it's that's the total, by the way, and total annualized rate of return is about 14%. So absolutely amazing company. I really like this business. I did own it at some point. I sold it. And yeah, so that is 7 companies I wanted to share with you guys. Before I move on, let me just quickly show you from Shariah-compliant side of things. And as always, if you haven't joined us at the Patreon account, please do so. Of course, it helps the channel. Now let's scroll down. There we go. So that's all the companies. So just pause this video and have a look at it. Normally what you will find is software companies, apart from the business side of it, sometimes is high or low, whatever, depending on that, within that 5%. But you'll never see them having a high interest debt levels or interest bearing securities that's high. That's very uncommon for this type of businesses. Just to wrap things up, of course, what is some of the risk? The risk, of course, we have competition, economic slowdown, and basically in some cases, like where the high value, if you buy stock in a high valuation and the growth slows down, then you are very much in trouble. So my approach is always buy it when it's undervalued, when there is at least a margin of safety. Try to diversify across multiple basically names, multiple sectors, and so on. Don't just buy all of them right now. That will be the craziest thing to do. What you should be doing is maybe buying 2 or 3 of these companies, but of course you've got diversified portfolio. And always check the Shariah-compliant side of things, which is very important to us. I hope you're enjoying this type of content. If you are, please of course like the video, subscribe to the channel, tell family, your families and friends and people that you know that are interested in Shariah-compliant side of things. And yeah, join us in the Patreon account where you get access to a lot of things, inshallah. Have a wonderful day. Assalamu Alaikum.